While everyone's panicking about higher interest rates crushing their mortgage payments, there's a flip side most people are missing. The same forces driving up your borrowing cost may have just handed you the best safe income opportunity in 15 years. If you're wondering why that Wall Street number should matter to your retirement paycheck, you're asking exactly that right question. My clients have been bombarded with headlines about rising yields, Fed moves, and bond market chaos. But when I sit down with them, the real question isn't what's happening. It's this: how does this actually show up in my monthly income? That's when I realized we need to have a very different conversation. For the first time in over a decade, you can lock in safe, guaranteed income at rates we haven't seen since before the financial crisis. With individual treasuries held to maturity, your payments are fixed and principal is backed by the U.S. government. So price swings don't matter if you don't sell early. And here's the thing: these higher yields aren't just noise. They reflect bigger forces: inflation, heavy treasury issuance, and rate expectations. And were amplified when the U.S. lost its last AAA rating, that is, in May of 2025. All three major agencies have downgraded us from AAA. It means the government has to pay more to borrow money, similar to our own credit rating, which creates higher yields for you guys. It's like getting a better interest rate because the borrower credit score dropped. Now, how you use this opportunity depends entirely on your current situation. If you own individual treasuries, you get your money back at maturity, period. Bond funds, now that's different. They rise and fall with interest rates, which means timing and strategy matter more than ever. Now, here's the bridge most people need. Don't confuse safe government bonds with bond funds that carry market swings. One gives you guaranteed income, other behaves more like stocks. Now, the answer isn't a simple yes or no. It's how does this fit your overall income plan? Because a 4% yield isn't just a number, it's an opportunity to secure part of your retirement income without any market volatility. And yes, mortgage rates staying high is part of that same story. When the government's borrowing cost rises, it pushes up rates across the board. Your mortgage, your car loan, everything, as you see, gets more expensive. But here's the silver lining when you're the lender instead of the borrower: higher rates work in your favor. We now owe more as a country than our entire economy produces in a year. That's like your household debt being bigger than your annual income. Okay. It's unsustainable, which means the government has to keep paying higher rates to attract lenders. Now, these aren't temporary crisis rates. They're the new baseline for a country with damaged credit. Think of it this way: these 4% yields are America's credit card debt finally coming due. Except instead of paying the penalty, you can collect it. As an individual investor, you can actually benefit from this institutional problem by locking in these higher, safer yields. But whether this is the right move for you depends on how it fits with your retirement income plan. The government's financial challenges can become your income opportunity only if you position yourself correctly. If you want to see exactly how to turn Washington's fiscal problems into your retirement solution, let's have that conversation. Because the difference between understanding the headline and understanding what it means for your life, now that's worth talking.